I feel like I should have prepared some jokes for you guys. I apologize. I didn't come that prepared. Thank you very much for the introduction. Thank you guys for showing up. Yeah, I've been in the construction industry. I grew up in it. My parents we moved here in 1980. I've made 3 Idahoans, so I think that qualifies me as a native at this point. But when I grew up, and I've told this to Robert Kiyosaki, I told him that Little Purple Book was the most unimpressive thing I'd ever read, because I grew up at a dinner table where my parents were talking about buying this property and selling that property and how to get cash flow. And that was all kind of wasted on me as a kid. I didn't really realize what I had my hands on and what I was experiencing going on at the dinner table and watching my parents work. My dad was a builder and later became a developer. My mom was a third generation realtor. And, I decided I was going to go to college. And so I went to Boise State, and I'm sitting there going to classes, and they want me to show up every week and, continue to do my homework. And that really wasn't what I wanted to do. And I'm watching my brother in 1995 make about $48,000 a year right out of high school building single family homes. And so I decided that was what I wanted to do. And so I went out and I built a couple of houses, and I made the mistake of building one right next door to my own. And if any of you guys work with homeowners, that can be a real pain on a Sunday at about 2 o'clock when they've got a problem. And so I really transitioned at that point to commercial. I built a Garden City Police Station, North Ada County Fire and Rescue Stations, built medical facilities, schools, hospitals, city halls. There isn't much I haven't built. And what I kept watching was when I got done building for them, they got to keep making money on what I did, but I didn't. And so I really kind of was, at that point, I think I was about 27 years old. And I was watching my parents getting ready to retire on this cash flow thing. And I didn't realize that, I always grew up thinking my parents were poor. We couldn't afford anything. But I realized they were dirt poor. And the reason was because they buried everything in real estate. And I watched as they retired in 1999, and they haven't really had to do anything since then. And so in 2001, I built my first industrial building, and it took everything I had to pull this off. And I built this building, and 21 years later, I still have 2 of the original tenants are still in the building. And they've just sat there and they paid the rent, and they've let the rent increase. I started them out at about 39 cents a foot. Plus I think we were at a 9-cent triple net. We just closed on a building today. The rents are $1.25 a foot with a 31-cent triple net. And so, as things continue to increase, I watched my parents do this. And I realized at that point that investment was where I needed to go. And I really kind of began to transition my mindset into owning properties and making that work. And I began to look for people that wanted to partner. And I'd get a guy that, hey, I've got enough money, we could do this deal, and I'd do all the work, and he'd make half the money for having the money. And I began to see how this was a relationship that I was building, but then I was always having to go build another one. And for those of you that have tried to scale your business, you always wind up at the most inopportune times in your business with the most opportunity in front of you, meaning that you have no money, and damn it, there's a good deal, right? And so you're sitting there trying to figure out what to do. And I kept running into this problem. And it was 2017, I partnered with a guy in a family office, and we built a 180-unit apartment complex. And the equity check on it was $19 million. And I realized as we were drawing to a close on this project that unless he wanted to do another project, the chances of finding somebody else that was going to write a $20 million check was going to be really hard. But my business had grown to the point where these were the size of projects that we were doing, and this is the kind of capital that I needed to come up with. And at that point, I realized that I had to do something different if I was going to be able to put myself in a consistent position to perform. Because I had 2 other deals sitting on the sidelines that were in due diligence on that I kind of planned on closing, and I kind of planned on this guy being my partner. Well, then the matriarch of the family office died, and the kids all said, good, mom's dead, well, I can tell you what I really feel about you. And that didn't go well, so the family office got divorced, and there went my capital. And about that same time, I ran into a guy who came out of the movie business. If you guys know anything about movies, some of them are really good and make a lot of money, and some of them suck really bad and lose a lot of money. Well, banks don't like to finance things that suck, right? And so for years in the movie business, they've been syndicating capital. And really what that means, it's a fancy word for partnership. And we've all heard terms like mezz debt. We've heard terms like preferred equity. We've heard terms like limited partners. We've heard all these terms. A lot of times people don't understand how simply they work together. And as I began to work with David and began to understand how the spreadsheets came together and how things really kind of happened in the capital stack, it was really easy for me to understand how I could form a partnership with 50 people that had $250,000 that would get me what I needed to do the project rather than running around trying to find that one guy that was willing to stroke $20 million check. And for those of you that do math, don't check my math on that. But syndication is really a simple process of identifying people in really two different categories. It's identifying people who want to continue to live their life the way they're currently living it, and they want to be passive investors. And in that, they're looking for somebody else to do all the work. Any of you guys married? So you know what it's like to do all the work, right? But there's that part of investing where a lot of people are sitting here going, well, I have a full-time job. You know, we've got a lot of doctors, lawyers, we've got some high-end tech people that are making really great money where they're at. They have no desire to leave their tech job and go get into real estate. But they also see that the value is in some of the tax benefits that are available in real estate, some of the idea of passive income so that you're not always trading time for money as you are in your job. And yet they have a great source of income. So they're in a position where either they're going to work 50, 60 hours a week at their job and then turn around and try and do real estate nights and weekends and probably do mediocre at both and run the risk of losing money in real estate or, not performing well at their job and getting terminated there. You have people that want that. And so what I began to do at that point was to look around at people that I knew around me that simply needed something. And I really broke it down into three categories, and we've broken it down in our company into three categories of investors. And when you really begin to look at it during the rest of the conversation here, begin to think about people that you know that have these three problems. You've got the people that are doing really well in life, but they're always paying a ton in taxes. So they've got tax problems all the time, and they don't have time or they don't have desire to get involved in real estate for any reason, but they keep having this tax problem. And then you've got people that are in the category where they are looking for cash flow. They want that cash flow. And we all hear about cash flow and we all think about, man, that's great. That means it's mailbox money. It means that every month the money shows up in your mailbox and you didn't have to go do anything for it. But how did you get there? Because the stock market really doesn't provide that. Your mutual funds, those aren't really for you. They're for the company that's got the mutual fund to make their fees on, right? Because they always seem to get paid regardless of whether or not you do. People are looking for cash flow. They're looking for something that's going to continue to pay them, that's also going to keep pace with inflation, that's also going to appreciate in value. And there's very few items out there in the marketplace that provide that. And then the last investor that we find that we have is the investor that's looking for appreciation. And usually this person walks in the door and they want cash flow. And then we start asking very simple questions of, okay, don't tell me how much you have, but will 7% cash on cash every month, will that change your life? And they think about it for a minute. As you know, real estate provides a lot of tax savings, and I could show you how we could partner on a project and you could take advantage of those tax savings and I could do all the work. All of a sudden I had people's attention. You start talking to other people that they go, well, I really like cash flow. I'd like it in a real asset. I don't want the stock market that doesn't provide cash flow. I can't really bet on startup companies because they're too risky. Well, what if I could provide you cash flow with an asset that is right down the street? It's a warehouse building or it's a small apartment complex. And so as I began to have these conversations, I really began to see where it's almost everybody is looking for an opportunity like syndication. As we began to explore that, we began to look at how does syndication really work and what works best, because syndication's a lot like buying a car. You can get them in any flavor, any two-wheel drive, four-wheel drive, hatchback, pickup truck, whatever. But we began to really see where a lot of people in the marketplace were doing syndications in a very investor-unfriendly way. Before I go any further, I want to break down a couple of pieces of who's involved in syndications and how that works. So in syndications, there's usually two parties involved. There's the general partner, and he's the guy that's going to do everything. It's either one person or it's a group of people. They're the ones that have negotiated the price on the project. They're going to buy the project. They're going to hire the property management company. They're going to oversee the construction company that's going to do the value add. They're going to pick out the colors. They're going to make sure everything happens, and then they're also going to make the distributions to the investors, and they're going to be running point on the project. They're the ones that are going to be doing all the work. And then there's the limited partners, which are limited in everything. They're limited in liability. All they really have at risk is the capital that they put into it. They're not signing on the loans. They're not involved in any of the activities, so there's no liability for that. They really sit outside of the partnership, and there's an agreement between the two parties that allows them to participate in a format that is then described in what is called the PPM, or the Private Placement Memorandum, which is an SEC registered document, or should be. And that PPM is usually 140 pages of your attorney's finest, bland and boring language that describes the activities that are going to go on. And so when you start looking at that, then you start talking about, okay, what's going to happen? Well, we're going to buy this apartment complex and we're going to renovate the units and we're going to increase the rents and we're going to lower the expenses. We've got this business plan that we're going to actuate on. And we're going to go get the financing and we're going to negotiate with the insurance companies and we're going to take care of all that. And in that plan, there is the breakdown of who gets paid what. And typically in a syndication, the general partner puts in little or no money. Now, in our case, we put in 5% of the capital on every deal we do. I personally do. But I've seen a lot of people that as the general partner, they're just involved in the deal because they're the general partner. Then you have the limited partners that bring the capital that's necessary to secure the bank financing, but they're not signing on the loan. If it is a recourse loan, that's done by the general partnership. And so a general partnership can have, a group of people. Sometimes you have a KP, which is they're there for their balance sheet. So they're bringing their balance sheet to the table and the bank says, hey, I like the balance sheet. We're willing to loan based on that balance sheet. There's the operator side of the operation. There's usually the guy that found the deal. I've seen syndications with as many as 9 people in the general partnership. That gets kind of messy. Then you've got what everybody calls the underwriting. And what happens in the underwriting is we look at, okay, right now, this apartment complex has got a $120,000 annual net operating income. That means that we've got 36% expenses, we've got our rents, and then we've got our 36% expenses, and then we have our net operating income. And based on what you guys know about cap rates, the project is bought or sold based on a cap rate, which is a capitalization rate of what the return is going to be on the project based on the cash flow that's coming off of it. And so as these partnerships come together, you start to see people start to figure out, okay, we're going to do a 6% preferred return. That means that the capital we generate, the $1 million, the $2 million, the $5 million, they're going to receive the first 6% of the profits on the job. That's going to be their preferred return. And then we're going to go from there into an equity split so that at that point, after you've received a 6% return on that capital, then the general partners are going to start to take a piece of that. And that can be anywhere from 5%, 10%, all the way up to 40, 50, 60%, however rich that it wants to get. And so in that, what you've really decided is you've decided that based on the pro forma, what we think we can do to the NOI, we're buying it at $120,000 in annual pro forma, annual net cash flow, and we're going to do certain things to the project. We're going to improve it with new paint. We're going to put new deck chairs by the pool. We're going to put an exercise room in, a dog park, all these different things that people do, and we're going to raise the rents. And then we're going to change that. We're going to take that from $120,000 a year in net operating income. Maybe we're going to ratchet that up to $150 in the first year and $175 in the third year. And then maybe in the fourth year, we're going to sell the project. And based on that, you're able to decide, or you're able to spell out, if we reach certain milestones, then the general partnership gets more of an equity slice in the deal. And these parts of it are called the waterfall. But really what that means is that the better the general partner performs, the better the limited partners do, the more the general partnership is rewarded. And so in all of this, really all you're doing is you're setting up a complete ecosystem that's surrounded around a single asset in most cases. And you're putting your money into a deal and you're trusting that the general partners are going to do their job. Everybody has, for the last couple of years, really had a lot of fun with syndication. There's been a lot of great things happen. But in the last 7, 8, 9 months, there's been a lot of cracks being exposed in what syndication has done and how some of these operators didn't really pay attention to the underwriting. And that's one of the things that a lot of people fear about syndication, is because when you get involved with someone, you're really at the mercy of the general partner. If he wants to, she wants to, they want to sell early, they're going to do that. If they've chosen to get bridge financing and now the financing went from 5.5% to 10.5% or 11%, you don't really have any control over that. One of the biggest problems that I've seen in syndication is that a lot of people actually just trust the pro forma. They just look at the information that was given to them and they don't trust but verify. And there's a lot of that in syndication, you need to be paying attention to which piece you are. If you're the general partner, you need to make sure that your underwriting is accurate. You need to make sure that it's really going to stand the test of the market. Because by a show of hands, how many of you in here thought that in January of this year that we would see 8% interest rates? Yeah, I didn't either, right? None of us thought we were going to get here. But how were you positioned in your real estate to survive that? So each one of you are involved in real estate in different ways, but you are, in most cases, people in this room are the ones that are involved. And so you've done the math, you've done the underwriting. You understand that whether you're involved with wholesaling or fix and flips or the BRRRR strategy or small fourplexes, triplexes, whatever, even up to multifamily, large scale multifamily and industrial, there's always that equation that needs to be solved for about what the market is going to do. And so if you're looking at syndication for the purpose of being a passive investor, there are a lot of things that you need to look at very closely. And one is the underwriting. How is it being underwritten? Are you buying a stabilized asset? Are you buying something that currently cash flows? And unfortunately, over the last 4 years, a lot of people have been involved in syndication, and the syndicators have been playing monopoly, or they've been day trading with real estate. And you see people that are buying at a 4 cap and projecting that they're going to sell at a 3.5 cap. Well, as long as interest rates continue to trend down, that wasn't a problem. But as you see the market start to change, and for those of you that have been around real estate for a while, you'll realize that this is a cycle. We went through the cycle in the S&L loan crisis in the 80s. I wasn't personally involved in it, but I saw the stress level in my house go up. My parents were dealing with not being able to get financing. We saw interest rates in the late 70s come down from 20% on new construction. They came down to a reasonable rate, and then we started to see bank failures in the late 80s, and capital became scarce. So I rode that cycle out as a youngster, and I didn't realize what was going on until I started putting it together later. Then we had the dot-com bubble burst, right, where that whole tech sector collapsed, and the funds that evaporated there and the millions of billions of dollars that evaporated from balance sheets everywhere. Now we're in another cycle that is very similar to 2008, but completely different cause. And so when you're getting involved in syndication, you have to understand at what point in the cycle are you at in the real estate market as a whole. You need to look at your real estate market that you're going into. You need to understand where it is that the deal is being done, because you might see a great deal in Los Angeles. It might be an 11 cap, which right now would be fabulous, right, if we could get an 11 cap. But then you're doing with that in California, which is not a landlord-friendly state. So you could do a great deal in a good market, but you really want to find a great market that you can do a good deal in. Because the reality is, if you're not paying attention to the greater market as a whole, you don't have that leverage. We've all been investing in Boise, Idaho, and it's been fabulous here for the last decade. We've got a place that people are moving into. We've got growing wages. We've got growing population. We have shortages of housing, of industrial. There's just about every asset class out there that has a shortage. And so when you're looking at what you can do in a market, you really want to consider that when you're considering syndication. And a lot of people that get involved in syndication are working in other markets. They're not working in their home market. We happen to have home field advantage here because we currently have right at about $130 million worth of work going on here in the Valley. But we're in Washington, we're in Texas, we're getting ready to break ground in Florida. We're looking at deals in Tennessee and North Carolina. But what we've really done is we've looked at those markets to ensure that where we go to place our assets and our money and our stuff is really in a growth market, because we don't want to be stuck in a market that's receding. And so when people look at syndication, they just look at the underwriting and they say, wow, this is a great deal. I love this deal. But you've got to understand, what is the rest of the market? We've all seen that house that's come up for sale on the street that is priced $50,000 too high. They're just not paying attention to the market. They've got the nicest house on the street, but they're not in the street that's 2 streets over where those nice houses are getting the price that they're asking for. And so you have to understand where your asset is being done. You have to understand who the syndicator is. Who is the guy behind it? There's been a lot of people that have found a way to raise a lot of money, but they don't have the ability to execute. They've never run a $100 million apartment complex. They've never taken care of 300 tenants at a time. They've never had to negotiate and never had to understand the dynamics behind hiring a property management company that can. Because typically at that level, you're dealing with national brands and they have a set way of doing things. And so you need to look at who your syndicator is and what's their experience is and what their level of liquidity is, because the last thing you want to do is be involved with somebody that can't cover the basic needs of your apartment complex, and then your asset begins to fall into disrepair because the general partner can't take care of it and can't find the resources to do that. The other thing that you want to look at when you're analyzing a syndication is just simply, is this the asset class and is it going to do what you want? And what I mean by that is, if you're looking for tax benefits and you're investing in a syndication in your IRA, you're really not taking full advantage of the tax benefits that are available to you through bonus depreciation on a large-scale asset. If you are investing in an asset that is set for cash flow and you have your only $100,000 in there, that's going to be a really slow boat to get you to a place where you're receiving enough cash flow that you can actually retire. And so you really need to understand those three things as far as where your asset is happening or the syndication is happening, where that or who the operator is and what their capacity is and what their track record is, and really drill into who they are and whether or not they can actually take this thing to the finish line. And then you need to look at why are you doing it and does this particular vehicle do it for you? I hear a lot of syndicators talking and they're pitching their deals and everybody's talking all about their great stuff and they think it's a one size fits all. And it's really not. Real estate is a very individualized game and offers a lot of different strategies in it if you're paying attention to what's going on. As you're looking at the opportunities that are in front of you and you want to minimize your involvement in it and you want to get into some bigger asset classes or you want to get into something that's a lot more stable, I'll give you an example. One of the projects that we're doing right now is in Houston, Texas. We bought a 33,000 square foot industrial facility for right about $6.5 million. It was built in 2020. It was fully tenantized, but the gentleman was filling it during this little thing called COVID. And so he was having a hard time getting it full. He finally got tenants in, but they were all below market rents. They got it all full. He signed everybody on 2-year leases because he thought, well, I'm getting really terrible rents, so in 2 years I'll raise the rents. He got permanent financing on it. He had a 4% loan for 10 years with a life insurance company. And he decided that he needed his money back out. He wanted to go do another deal. And so we stepped in and we bought that. We assumed the loan. So we took on that 4% debt. So we have 9.5 years left on that 4% debt. And as the tenants are coming up for renewal, we projected that we could raise the rents 3%. Now, honestly, I know that we can raise the rents a lot more than that. We've already raised 2 of the tenants 12%. But we projected 3% because I always like to be wrong on the side where I overachieved rather than wrong and missed the mark and promised 20% and wind up with 19.5. And so we began executing our business plan. Once we closed on it, we raised $3.5 million in capital. We bought the asset and we began to execute our business plan. We started out with a 6% cash on cash return day one. We're already up to about a 7.25% return because of the raises in the rents. But the goal is that at the end of 5 to 6 years, we're looking to sell the asset. And at the sale, we're going to wind up returning about the total IRR, which is the internal rate of return, which for those of you that are really good at math, you know that is taking the amount of money divided by the time that you had the money and coming up with the return that you made on the time included in that. So if you invest $100,000 and you get a 20% return in 1 year, we all know that is $20,000. If you have a 20% IRR on a 5-year deal, you've then been returned your $100,000 capital and you've made $100,000 in profits. So that's a 20% IRR. So we're looking for about a 17% IRR at the end of this deal in 5 years. We figured out that if we bought it at a 5 cap, we wanted to sell it at a 6 cap. Any of you that know about cap rates understand that's the wrong way. You want to buy it at a 5 cap and sell it at a 4 cap. However, if my underwriting says I can sell it at a 6 cap and still produce a 17% return, how pissed off am I or my investors when I sell it at a 4.5 cap or a 5 cap or a 5.25 cap or something like that? And so it allows me all of these kinds of opportunities to take my underwriting and provide the benefit to my investors through experience. When you look at how these things go together, it's very important that you take the time to understand who the syndicator is, what they're offering you, and what you're trying to get out of it. And when you're evaluating those kinds of things, it will really help you to understand what you're going to get at the end of the game. We've raised about $58 million through capital raising and put that into syndications, and we've allowed ourselves to do incredibly well for ourselves and our investors and leverage what we have and be able to take on larger assets that in a lot of cases are a lot more stable than smaller assets, and has allowed us to scale much quicker. But at the same time, you have that inherent responsibility where you have to take care of your investors, ensure that they're getting the returns that they want, so that at the end of the day, they're able to get what they're wanting out of life. And a lot of people have kind of lost sight of that. I think I'm being told I need to wrap up here. But when you're looking at evaluating syndications, just make sure that you understand who you're working with, that the asset class is something that you're wanting to deal with, and it's providing you with the tax benefits and the cash flow and the appreciation that you're looking for. and that you clearly understand it. So if you have any questions from the syndicator, ask them. Ask them exactly what this means. Ask them to explain the underwriting. Ask them to explain what they have in reserves. And so you want to make sure that at the end of the day, you have done your due diligence, because when you're getting involved in a syndication, you are really going into a partnership, but you are the silent partner. And so with that, I'll kind of conclude my overview of what I think you should be looking for if you're looking to get into syndications. And I guess we'll open for questions. Except for Brandy.
Why do you still love Texas?
Oh, well, see, this is where we look at markets, right? So Houston had this really huge thing happen during COVID. Their port opened back up. They're now busier than they've been in about 25 years. And we looked at the market, and in Texas, the average household income is about $58,000. When I'm building multifamily apartments in a new format, I need to be able to start with $2,000 rents. $58,000 a year in annual household income isn't going to be my tenant. They do have a booming oil sector, but that's going to be downtown. That's not going to be where I want to build. So we looked at that and we said, you know what's a great asset class in Texas, in Houston, is industrial. And one of the reasons that everybody in Texas is getting their butts kicked is because insurance has just jumped up 300%. Now let's talk about triple net leases, which is what industrial is. In an industrial lease, I do a triple net lease, which everybody does, which means that the taxes, the insurance, the maintenance, the property management, lawn care, paint jobs, whatever, that is a pass-through to the tenant. My rent is established and my triple nets are flexible. So every year we make an estimate. They contribute toward that. At the end of the year, we reconcile. If I owe you money, we'll take that out next year. If you owe me money, that check's due right now. And so when I looked at that, I said, wow, their port is coming on strong. Their employment rate is pushing upward, or their unemployment rate is pushing downward, their wage is pushing upward, but it's not enough for us to be able to afford to build multifamily. So we went into the industrial field, and that's where we like those kind of assets. But again, it's about knowing your market and knowing what's good in that market. So good question, actually. So I take that back.
So when you mentioned in the industrial, are you looking for value add more than cash flow then? Because you're mentioning get out in 5 years.
Well, so when we look at that, you know, at first I thought investors wanted to get in and out, right? They want to get in, they want to do their deal. But as we started to see return on capital for our investors, they were looking at me like, why'd you create this problem for me? I mean, you just gave me my money back. That's great. And it's got friends. That's awesome. But now what am I going to do with it? And every time that money surfaced, I got to pay taxes on it. We look at a 5 to 7 year window on most of our deals. And we will do a value add on that one, but it was a 2020 build. It was 2 miles from the hospital. It was right off the freeway. It was priced the same as the 35-year-old building right next door. So it had all the things there that were going to be a value add without any add. We were just going to be able to increase rents. And so what we typically do is we do a lot of development. So we do the original value add where we take the sticks and stones and we create something that then the tenant monetizes for us. And based on that cap rate, we create that original value add. So we're not buying somebody else's, hey, we bought it for, $3 million. We did this and this to it. Now it's prettier and better. So we're going to sell it to you for $4 million. We create that. We build it for $3 million. We come up with a value of $4 million. We refinance a lot of the profits or a lot of the initial investment back out, return that to our investors, and then hold on to it. That 5 to 7 year window, the reason we put that on there is because we have 9.5 years of debt. I want to be at the end of my expectation with you and I in this partnership and have room to go, well, this year's not the best year to sell. We can all agree that last year would have been the year to sell. We can all agree that the end of 24 is probably going to be good again. We're going to go through this spot. I didn't want to be sitting there at the end of my 9 years and looking around going, so that's why we put that 7 year window on it. When we do have the opportunity for our investors to exit, we typically have a tax strategy for them so that they can skip the tax guy. We had a closing, actually it was postponed from today, it'll close tomorrow. And the group of investors are doing a 1031 and they're all going to another investment that is a similar type, similar style, different state. And so they're going to go through the 1031 process and avoid the taxes. Good question.
So Shannon, a lot of the people in our group are in residential. If they want to get started with syndication and commercial, what are they looking for when they are interviewing general partners?
The reality is you're looking for that track record. When you go out and you do the deal, you're betting on you, right? You understand you. You're the one that stays up at night with you, right? You're the one that's walked the property. you've really got to understand that the person that you're going into partnership with as a limited partner has that experience level to be able to do that for you. And so what I encourage a lot of people to do is interview the syndicator before you look at their deals. Get to know them, understand what they've done, understand how long they've done it for. Get some references of people that have invested with them and find out how do they communicate. You know, one of the things that we do when we're building buildings is we put cameras on the job sites. We log those cameras and we see that most people go in and check those cameras 5 to 7 o'clock at night and a lot on the weekends. And I bet it's a group of doctors where the guy's going, hey, look at this, man, I'm building this apartment building, right? Because they can see it and they can be tangible with it. We create a newsletter, we communicate all the time. I've got a gal in my office, she's investor relations, and all she does is make phone calls and connect with investors. Make sure that they understand that they got their K1s, that they got their newsletter, that they're getting the information that they want. And so you need to be able to understand that level that you're expecting is what your partner is going to be able to give and has given in the past.
Anybody else?
Okay, so 2 questions for you. In this market, what would you be looking at to invest in right now? What's like a hot market? We hear a lot about storage units, multifamily. And then what kind of deals do you like to do?
So like I said, first thing I do is I look at a market. So I wouldn't look at an asset class in particular first. So I would look at, I really like Raleigh, North Carolina. But what I look at is what's the growth, right? You've got about a $74,000 annual household income. It's above average. Housing costs are below average by about 5 or 6% in the nation. They've got huge tech markets moving into there. Duke University, they invest, I believe it's $60 billion into R&D annually in the Triangle area. So you've got a lot of opportunity happening. You've got I think it's about 4.5% annual growth in the Raleigh Triangle. So all of those things tell me that's a really strong market. So then I look at that market and I'll cut into that market and I'll say, okay, what is undersupplied? Well, housing is undersupplied, but interest rates have slowed housing. So if I'm going to look at that market, I'm going to look at multifamily versus single family because of that aspect. With housing usually comes the need for mini storage, right? Also brings new businesses, so industrial is strong there. And then you look at the other factors that are there. Raleigh's one of the few markets that is undersupplied on office right now. So when I look at and I decide on a market, then I decide on an asset class based on that market. Raleigh is getting on the high side for building costs. So multifamily is pushing $2,300 in needed rent when the market is $2,000, right? So $2,000. So I'm going to have to bet on appreciation. I might have been more bullish 3 years ago, but right now I don't really want to do that. And there's not a ready supply of assets in the area that are available to buy. Okay, so that really put multifamily out of that market for me. Then I began to look at industrial in that market. There's a lot of tech going on. There's a lot of biomedicine going on. And so I began to really dive into the industrial market. I like industrial during this time in the cycle anyway, because industrial is really recession proof. You check your facts, more businesses are started during a recession than any time in history. If we're not in one, we're headed for one quickly. And then the other thing that's happening is we're in an inflationary cost environment. Property taxes, we peaked in 21, 22 for property taxes. Those are now all getting rolled out through the counties and the cities and the states to you as property owners. The triple net lease allows you to pass that on. So I really like industrial in that market, and that's what we're pursuing. Not that mini storage can't be. I've built a couple of mini storages. They're an asset class. They're just not my asset class. So they run hand in hand with you need the growth in the housing. And if that market is fixing to stall out a little bit on the housing, I really like to stay toward the industrial side. So I stay in the multifamily or the industrial, but in Raleigh, we're doing industrial. So that's really kind of how I break it down. And then the other thing that's favorable right now, especially in the lending environment, is that life insurance companies tend to like industrial products. They don't lend on multifamily, but they will on industrial and office. Right now, life insurance companies have favorable rates and long-term loans that are allowing us to lock in a decent rate. I mean, I know you guys don't think this is decent, but I did my first deal at 9.5%, right? So interest rates here, as long as the deal pencils, it's okay. But the main focus that we're doing right now and that we're really focused on is making sure that the deal we buy today, when we sign the papers and we sell it, or when we sign the papers and we buy it, it cash flows. So if it doesn't cash flow on day one and give us opportunity to improve it, we're not really that interested in it, because right now we need to pay the bills, we need to be consistent, and we need to know that we're going to be able to do that for the next couple of years while we ride out whatever's going to happen. Does that answer your question?
Yes, but I have another one.
Okay. They're $2 a piece, and I'm going to need a credit card.
Okay. So I got a free book.
Oh,
Okay, so in this market, would you consider, well, in any market, would you consider light industrial and industrial the same thing, or do you?
no, they're not. So a lot of people think of industrial, they think of the rusty old metal building with the cranes around it, right? And the the old junk dump trucks or whatever. When I think of light industrial, I think of what is on Executive out between like Maple Grove and Eagle Road, right? So I'm selling a building right next to the Blue Cross Blue Shield right there on Hickory and State, right there by Sensi. And in that building, we've got Black Box VR, we've got a golf cart supplier, we've got K9 physical water therapy, where they actually have this big above ground pool. They do therapy for dogs by swimming them. We've got a car inspector that works for Carvana that does the car inspections for them. And we've got one other tenant. So those are what we would consider light industrial. Heavy industrial would be, something that I really don't go into much, just because you're dealing with chemicals, you're dealing with environmental issues, you're dealing with a little bit different animal, and it's not necessarily as tradable, nor is it as releasable. When I look at the building that I'm selling today, I have 5 spaces. One of them, they go from 2,300 square feet to 4,000 square feet. Those are very easy to release. My tenant improvements are minimal. I've got an office and a bathroom. Other than that, it's pretty easy to find another tenant for that. So I tend to go into the light industrial, and it's a very different market than the heavy industrial.
Somebody was interested in, that has a business that needs light industrial, but needs help financing light industrial to grow their business. Are you that person, or are you just working with investors to build projects, buy projects, and lease them?
We are actually working with one of our current tenants. We bought a building, we've rezoned it for 200 units of apartments, and we have 4 tenants in that building that we'll be tearing down. And one of the tenants wants to build a new facility. They're at that point where, dang it, in 3 years, we could really afford the facility we want. The down payment's a little bit of a struggle, getting all of that done. And so we're actually exploring the opportunity of building the building for them, leasing it to them for a period of 5 years, and then having a seller or a tenant buyback in there. We did that with, used to be Idaho Athletic Club. If you think about an athletic club, you're membership based. So when you go to the bank and you go, I want to open a new athletic club, they say, well, you don't have any members. So we would go in and we would build the facility, and we would lease it to them for 3 years. In that 3 years, they would get their membership up, and then they would take it to the bank and finance it out. So we've done that multiple times, because that's an easy thing for my investors to understand, because I can say, hey, we're going to go in here and we're going to build 40,000 square feet. They're going to occupy 20 with the understanding that they're going to expand. We're going to take the risk. We're going to lease out the other 20,000 square feet. In that time period, the building is going to appreciate in value, but the good news is the tenant is going to be able to grow in place and then purchase their facility. So yes, we have done that before.
And so would that be similar to a lease option where you're determining the rate ahead of time, or is that still at 3 years out negotiating what the price is of?
I would prefer, and I think my investors would prefer, if we fix the price now. And I think the tenant would as well. It's just going to be looking at that and saying, okay, this is what we're going to do. Then it's very easy math for us to calculate our investor returns, and then move forward with the project.
Thank you.
Yep.
Shannon, how much do you do now that is like value add versus new construction?
Well, I would say that about 90% of what we do is new construction. We do have the deal I mentioned in Texas. We have an apartment complex in Washington. Most of the stuff that we'll acquire probably over the next 36 months will be value add, because we're running into that problem where things continue to get more expensive, but rents aren't really going up like they were before. So, well, Brandy, you know this better than anybody, right? You could afford to pay 15% more for the house next door because you knew you could get it on the sales price. Right now, the market's kind of gone stagnant. You can't really build into that. So we're finding ourselves looking at it, and with cap rates coming back into a range that's normal for us, we're able to say, hey, you know what, at a 6 cap, if we're buying a building at a 6 cap, that means that $6 million building is returning $360,000 a year in NOI. I can finance that all day long. My investors will like that all day long because the minute they put their money in, they're getting a 6% return with an opportunity for that 6% to turn into 9 to 12, and then at a cap rate, be able to exit with an additional 10 or 12% on top of the cash flow. It really is, again, cycle dependent as far as when that happens, even though the demand that we had for housing is only being exacerbated by the funding rates that we're seeing. And I think that multifamily is going to be a great place to be in 18 months, but it will also be behind the cycle, so it'll be driving rents dramatically. I think you're going to see rent escalation in 25 to be probably back to that 15 to 20% that we've been seeing around here lately.
So when you're underwriting your deals, so you said you like for new construction, you were building into that rent model. So when you underwrite your deal, whether it's new construction or rehab, you're assuming a certain appreciation in rents at the time that you're underwriting. You know, what are you assuming?
So we're assuming,
Large home builders,
yeah.
in the past that would underwrite a deal very conservatively and say, we're going to sell it at this price today, and we're not going to factor in any price appreciation, even if it's a 5 or a 10-year build out, just to be underwriting conservative. So what's your underwriting?
We're doing a 190 unit apartment complex in Meridian. And when we first looked at the deal, rents were about $1,600 in Meridian for a 3-bedroom, 2-bath. Now we're going into lease up and we're getting 75 for those units now, right? I'd love to say that I did that, right? That I knew that was going to happen. But the reality is we had to underwrite to that 1,650. The bank allowed us to add a 3% appreciation annually to that. So we were able to add 6% to that. And then we had to build and have it go into that model. The thing that's happened is as rents have gone up, cap rates have expanded also. So we've been kind of flat. The great news is we had a $75 million appraisal on the project then. We're looking at about $79 million in value today, even though we've seen $400 a month in rent appreciation. Does that make sense?
Yeah, but in that same time, you also had an increase in construction materials, labor, time delays, shortages.
Yeah, yes and no. The great news about some of these large scale projects is we locked in all of our pricing in 19. We signed all of our contracts in 19. So we've got guys out there laying stone right now at 2019 prices. So electricians, plumbers, heating and air guys, but see what they looked at is they looked at $1.5 million job. And I don't think they bid it at what 19 prices were for CBH on the plumbing, right? I think I was paying a little bit more. So they also know that it's going to be a multi-year project, but we're very clear in there that we do not have an escalator clause in there.
Because over the last few years, the home builders, obviously they were locked in, people were trying to get out of those contracts and the prices they quoted on material.
And that's a difference, that's a shift in mentality in the size of the project. Corey Barton in 2015 was building a 2,500 square foot house in 4 months. In 2020, that was taking him almost 9.5 months to get it completed. So he's changed his pricing model a little bit. And then we had what happened with lumber. I'll tell you a funny story about Summertown. We bid the lumber package at $500 a thousand on lumber, right? That was what lumber was trading at. During COVID, it went to $1,750 a thousand. Now, what that meant was my $5 million lumber package was now closer to $15 million. So before I ever got started on the project, I was $10 million upside down if I chose to move forward. So I waited, I scratched my head, I waited, scratched my head. Lumber came back down to about 1,100 and I bought it. Or actually, I bought it on the way up at 1,100. And when it got to 1,700, I sold it. So I made about $4 million on the lumber package that I never had delivered to the job site that I then used to cover the bottom half because I had to go back in and wait until it got down to 1,100, which brought me down to where my value was at what I'd bid in there at 500. So those are some of the things that happen on large scale. But as much as we can, and I think on a typical job, we bid out or we buy out about 84% of the project before we actually break ground. So we've got excavators on the job. They were on the job Tuesday when I was out there, finishing off the last of the little things, but they're still under the contract that they signed in 2019. No, absolutely not. But in 6 months, they'd be happy to get those prices. Thanks, guys.
Shannon.